Welcome to this explainer video how to build a DCF model step by step. What is a DCF model? A DCF model is a spreadsheet where you use the discounted cash flow analysis to value a company or an asset. In this case, we want to value a company, and what you need is a forecast of minimum 5 years for this company, which basically I have already prepared. I have here an income statement, I have here a balance sheet and a cash flow statement, how the company's financial situation is expected to be over the next 5 years. You will also see, in order to do that, I'm also using 3 years of historic data. The idea is that you want to have this data to cross-check another time what's the difference to the future, and if the future is very different, you want to dig in and you want to understand what's changed. So there's another story how to build this, but for DCF analysis, that's what you need. I'm also using complete financial statements because I want to have a more precise picture, and if you don't do that, if you just take the direct cash flows, it's a bit more likely that you will when you would build the whole three statements, that there might be something flawed. So I want to be a bit more careful, and that's my way to do it, by making sure that I'm clear that the balance sheet will match in the future and all the cash positions at the end will end up on the balance sheet. That's important to me. Okay, so now step by step, how to do a DCF valuation. So the first step is you need to build the free cash flow to a firm. And here the components to do that is, the first component is you need to start from the company's EBIT, earnings before interest and taxes. You get that from the P&L. Voila. I take this over the next 5 years. Then I need to basically take the taxes. Here important is we neglect the financing structure. We want to know what are the cash flows before taking into account any interest or any other cost of debt. So this means I take the company's profits and I directly apply the company's tax rate. So I have here a tax rate. This will be a cash outflow. I will pay pro forma. These are the amounts of taxes I'm going to pay pro forma. Then, as we are looking, free cash flow to firm is a cash figure. So what we need to do is, if we start from a EBIT, which is a profit figure, we need to add back all non-cash items. And the most important one here is depreciation and amortization. So we add this back, and basically these two lines, we are back at EBITDA. Now we need to deduct all investments. So one investment goes into the buildup of net working capital, or the change in net working capital. So we need to see what will be the expected changes in the future. We get this from the cash flow statement, and we add this up. Voila. And you will see this is how much you have to invest net in the buildup of net working capital. Another part of the investment goes into CapEx. So we also deduct this. You will find CapEx here in the investing cash flow. We can just link it here. Voila. And this gives us the free cash flow to firm. And what's now happening is that we need this for 5 years. 5 years is a good number, because this year you'll have a very good idea what your free cash flows look like, because you will have worked on your budget, so you know this more or less. The years thereafter are more difficult to predict and will become more imprecise. After 5 years, it's nearly impossible to know what will happen. So the best you can do is you basically project up to 5 years, and this year needs to be a normalized year. And what you can see is that this normalized year, also you need to do some checks. You need to make sure that the relationship between capex depreciation is makes sense. It's nearly the same, or if not, that capex is a bit higher if your business is growing. And you also want to make sure that your EBITDA margin is at a level which you believe is sustainable in going forward. So voila, we go back here, and now we build, it's called the terminal value. And because we don't include the cash flows after year 5, we need to still value them. The way to do that is, I don't want to go into a Gordon growth model, WACC minus the growth rate. No, what I want to do is to keep it very simple and simply take the EBITDA multiplied by a multiple I believe is appropriate. So in this case, I believe it's 5 times EBITDA. This you need to research, and depends on the company and on the industry. And it basically gives you the value at the end of the year 5, and which results here in the free cash flows to firm for the next 5 years. The next step is you need to discount it. These cash flows have a different value than if you would have the sum of this today in cash. You would prefer to take the cash, so these are risky. There is some downside risk, but there is also some upside. For discounting, we will need to use a discount rate, which in this case will be the weighted average cost of capital of our debt and equity financing sources. This normally requires to do a separate in-depth analysis in order to come up with the value of this. As a shortcut, what you can do is to look at similar companies, how much their WACCs will be, and your WACC probably will not lie far away. So this is a shortcut how to get this value. So what we need to do then is to discount this future free cash flow to firm to their present value. The way to do that is that we we need to be clear what is the valuation date. In this case, we want to value the company 31st December 2017. All these cash flows will be in the future. In this case, we assume they will coming in at the end of the year. So this means end of the year, it's 1 full year of discounting, and we basically divide, we can now keep it simple, we just divide 1 plus 10%, we get a factor of 0.9. We multiply the free cash flows for this year. In the next years, we basically keep doing the same. We take the previous factor, we divide again by 1 plus 10%, so this factor gets smaller and smaller. Then we basically multiply each year with the free cash flow to firm with this factor, and we get the discounted free cash flows. Voila. And at the end of the year, at the end of year 5, you see this amount is highest because here it also includes the terminal value. That's what we have done before. What we do now is we sum up all these future cash flows, and it gives us the net present value or the enterprise value of the company. So if we now want to have only the value of the equity portion, what we do is we deduct the financial debt from the balance sheet as of the valuation date. In this case, we have 3.5 million financial debt. Plus, we could use the cash to repay that debt. So we add the cash which we have on the balance sheet. You will find that also here on the balance sheet, and this gives us the equity value. Last step to do is we check what are the implied multiples. We have here enterprise value in relationship to EBITDA. We shortly check what's the enterprise value if we divide by EBITDA. It's basically 5.2. And the other ratios we can also shortly check are P ratio and price to book. Here this P ratio does not really make a lot of sense. It's very low. It has to do with the leverage here, but in this case I would stick with EV/EBITDA ratio. Okay, so this should give you a good idea how to run such a DCF model and how to build it very quickly. That's it. So we hope this explainer was useful. subscribe to our channel to get more insights into financial modeling, and visit our website efinancialmodels.com. You can find plenty of financial model templates there. A link to the model is included in the description below. Thank you for watching.